Good morning, traders. Welcome to the Pirate Traders live stream. My name is Charles. I am an ES futures trader that uses the market profile to give myself an edge by looking at the market as an auction process. By looking at the market as an adoption curve on various time frames, that helps me to understand what is the most likely thing to happen. Come next. Wanted to go live this morning because I think there's a lot to talk about today in terms of TA and what to do in situations such as this. I want to start by just talking about coming into this morning and what was expected. Yesterday we had a gap down day, and then the market created momentum lower and it closed with a spike down at the end of the day. Closing with a spike down tells us the market still has momentum down and is likely to continue lower. So when the market closed yesterday, I was predicting that the market would go lower based on these principles, based on the idea that if you have momentum down, until the market gives you a sign the momentum down is over, you're going to keep going down. Closing at the low is not a sign the momentum down is over. Therefore, we needed to keep going down. Now, could I have predicted this kind of move to the downside? No, of course not. I didn't think we were going to make this big of a drop in the overnight, but I did think we were going to open somewhere below 54.54. The reason that that's important is because when I went on Twitter last night, for whatever reason, and I cannot explain it, everyone in my feed was saying, buy the market, we're going to go up tomorrow. And it just made no sense to me because sure, if you want to look like a king and you're looking at a long-term chart, and you're trying to pick an exact level where you're like, oh, the market is going to reverse right here. You're looking at yesterday's range and you're thinking maybe that was the low and we could reverse up and out of here. But you were just guessing. And apparently that's what most people on Twitter do, is they just guess. So that if it bounces the next day, they look like a genius, like they picked this low. But that's not how I trade. That's not how I approach markets. I take the market's information step by step, day by day, minute by minute, to tell me what is coming next. And maybe we did come down to a magical support level on the daily yesterday, but that doesn't mean the market has to turn around and start going up. What we need to see in order to assume the market is going to turn around and start going up is a change in momentum. We did not have that at the end of the day yesterday. We had a spike down, which was a sign we still had momentum. So I'm not sure why everybody was so convinced that the market was going higher today at the end of the day yesterday. It is quite baffling to me. So, if you guys were watching my live stream yesterday, which some of you were not because we're public right now, and if you are new to the channel, please subscribe. If you are not new to the channel, please press the like button. As a matter of fact, everyone press the like button, because the more likes that we get now, the more new people will come to the channel, the longer I'll keep hanging out and keep streaming with you guys. Okay. So yeah, if you guys were watching my live stream yesterday, if you were in the brigade and you were watching it, I talked about the fact that yesterday was a potential breakout of balance on a weekly time frame. So let's go to weekly candles. And we could see that where we opened yesterday, we were like right in here. Okay, we had the chance to either break out of the multi-week long balance to the downside or to poke below there and then come back up and close back inside the balance. Well, we closed with the breakout. That tells us the market is likely to make a move the same size as the range of balance. So that lets us be comfortable shorting because we know the market is going to make a move. Well, look what it did in the overnight. It did the entire expected move to a tick from the breakout of the weekly balance. So what does that mean to me as an intraday trader today? Well, it tells me, for one thing, I missed the fun. The overnight traders got to have all the fun. We knew the market was going to go down towards the low 5200s. We said as much yesterday morning, but we missed it because it happened while we were sleeping at night. So that puts the regular trading hours traders, you and I, in a really shitty position because the overnight got to have all the fun. The overnight got to make the move. So now what we have to do as regular trading hours traders is we have to absorb that move lower. We have to basically spend some time balancing because they went too far too fast. Okay, so there's essentially two different ways the market can balance off this move that we made in the overnight to the downside. One way is we can go sideways with price, which is what we call balancing with time. And you basically just stay in a range, going sideways, up and down for however long you need to. Maybe it's a few hours, maybe it's a few days. You go sideways as long as you need to convince participants to go long or short for the next move. Okay? The other way that you can balance off a move to the downside is with price. And that is by pulling back up with price. Okay? So one of those two things in my mind right now is the most likely thing to happen today. This is all based on auction theory and auction process. The idea is that if there's an adoption curve and you got a certain number of people that are going to go short today, like they are going to exit their stocks today, most of them have probably already done that. Most of them probably got taken out in the overnight or they're getting out right now. Okay? So most of the selling pressure is probably over. We're probably in the tail end of the sellers here. And so whether we get a bounce with price where the market goes higher or we get a balance with time will be based on once those last sellers exit, what happens next, right? So to me, one of those two scenarios is most likely today. Either sideways in the lower end of the overnight range, or we turn around with price and we try to fill the gap. We try to get back up to yesterday's high. I do not think we would fill the gap, but we would at least try, right? We'd start heading in that direction. And then there's door number 3. Door number 3 is another gap and go, right? The same thing that happened yesterday happening again today. Yesterday we had the gap down. We got new selling in the morning, got us below the overnight low, and then ended us much lower, right? We could get that same thing today where we have the gap down, we get new selling, and we get below that overnight low. To me, that is the least likely thing to happen today, but certainly not impossible. So what? Okay, so Charles, you just explained a bunch of stuff to us. You're saying it could go up, it could go sideways, or it could go down, and you think the highest probability is that it's going to go sideways or go up. Okay, great. The market is open, it's going down. What do I do? Do I short for the least likely scenario, the market going to the overnight low? Or do I go long? Because if the market's going to go sideways or higher, down here, this is the area of support. The answer is you do none of those things. You just sit on your hands for the first hour or two today and you just relax. You just drink some coffee, have a muffin, eat a cookie, just chill, dude. You don't have to be in a trade first thing in the morning. Let the market spend some time figuring out what it wants to do. If the market is going to have momentum lower or it's going to reverse and come back up, it will give us signs now that the market is open, that we can then use to take trades. Until we clearly know what to do, the best thing to do is nothing. Just relax. Just because the market made a huge move should not make you feel you have to get in a trade. And if you woke up this morning and felt that way, man, I got to get long, I got to get short. Oh man, it's moving so far, so fast. If you felt that way, you have a lot to learn about how trading works, particularly day trading. Days like today are not the days where day traders make their money. The days where day traders make their money are the regular, normal, average every day where the market is just doing what you expect. Days like today are where gamblers get the shit kicked out of them. And every now and then somebody gets lucky and makes a lot of money. That's what days like today are. So first and foremost, this morning, don't force trades. Just relax. Wait to figure out what the market is doing before you do anything. And then secondly, if we end up having a sort of choppy sideways day, I would recommend if you're a newer trader, you don't trade at all today with live money, only paper trade, or honestly, just take the day off. Okay? Because if we are going to balance with time and just go sideways in the lower end of the overnight range, it is going to be tricky all day. The market it's going to be one of those days where the market reverses at random places and it's very hard to predict. So today is not a great day if you're learning how to trade to try to risk money. It's just not. Any questions on any of that from the chat? Nap in the house, good morning to you. He says, we got Powell, who speaks about the economic outlook at 11:25. Well, we will try to watch that here together. See what Papa Powell has to say. Remember, the markets will react to things that he has to say, especially now after, these major changes in economic policy. People are going to be very curious to hear what Powell's reaction to all of this is. So anything after 11:25 could become very random. The market might look like it's doing something, and then Powell says something, and all of a sudden it reverses. So keep that in mind this morning as well. I just think today is a great day to just watch markets and feel no need to force trades. Okay, so you guys can see that I am going to be deleting a bunch of levels today because we already passed through them. Once you pass through a weak or poor reference, it disappears. It's no longer there. However, I am going to just keep the lows on my chart, any daily low, as that might become resistance later on in the day. If the market makes a move to the upside. Okay, so this is the last area for support where I would expect buyers intraday today to defend the market. I would say between where we are right now, 52.60 and 52.46. I know it's a large range. It's very volatile. Hard to give exact levels for reversals here. But this is where we should find support and turn around and come back through the opening price. If we do not, if the market dips below 46, then we will start to see this as selling pressure that could take us to the overnight low. But as I mentioned earlier, to me, that is less likely today. I believe this is the very last of the sellers getting squeezed first thing this morning. Buyers getting squeezed, becoming sellers. And so this is where we start to get that chop, that sideways, that grind. So do we turn this area into support? As a way to try to measure whether we are getting support or not, I'm watching the tick chart. That is ticker symbol TICK. Okay. This is measuring the stocks in the NYSE that are going up versus the stocks in the NYSE that are going down and showing us the delta between the two. So when it's at 0, that means it's the same number of stocks going up a tick versus down a tick. Whereas if it's a lower number, if it's a negative number, that's more selling than buying. So if I'm asking myself literally right this moment at 52.46, is there support? I'm watching where are the ticks right now. They're at negative 1,000. So do they go up towards 0? That's a sign of support stepping in. Can they get to 0? That's a sign of whether it is strong enough support to reverse us back through the opening price. Let's see what happens. I teach all of this in depth in my Mastery of Markets and Minds workshop. You can check it out by just going to marketsandmind.com. There's also a link in the description. If you're interested in signing up for the workshop in April, you don't have to be able to watch it live. So if you have a day job or whatever, you can just sign up for it, and then you'll get the recordings that you can watch after the fact if you can't watch the sessions live. But I'll be teaching that over a 2-week period of time. It is a mastery course. It is everything about trading. It is not just how to read market profile, how to make predictions about what's going to happen with price in the future. It is also how to manage risk, how to develop trade setups, how to grow as a trader, how to improve your results consistently over time and continue to grow and adapt and develop, to the live markets. So I don't teach these courses often, and we happen to have one coming up. So if you're interested in joining, head to marketsandmind.com and use promo code Easter when you sign up. That'll make it only $300 to sign up for the course. It's normally $450. So it is on major discount for the next couple of weeks, and then it becomes much more expensive. So if you're thinking about signing up, I would recommend doing so now. I also offer a money-back guarantee until the day before the workshop starts. So if you want to sign up now, lock in the savings, using the Easter promo code, and then you decide, a month from now, you don't want to do the course anymore, you can always just email me and I'll refund you completely. Okay. So something to think about there. All right, so this is the moment of truth for the ticks. We got the support. The ticks moved from negative 1,000 upward, so that's a sign buyers are stepping in. Okay, the next question is, can they get to the zero line? If they cannot, then this thing is heading to the overnight low. The support will break and we will continue. Can the buyers hold it? Good morning to Zach L. Welcome. Vu in the house. Good morning to you. Pavel is here. Good to see you. Will in the house. Good morning. DNK says, good morning. A day to maybe just watch and not trade, as a lot of people will be liquidating their positions, and as well as some big short covering rallies as market makers try to stay in positive profits. I agree. That is 100% my sentiment today. Today is not a day for amateurs. And the thing about it is, this is how gambling works, right? The brighter the lights, the louder the sounds, the more likely people are to walk up to that machine and put a quarter in. So when people see, people who want to learn to trade, they see these big ranges, these extreme days where the market is moving 100 points without breaking a sweat. They're like desperate to trade because they feel like, oh, this is where I get to make all my money. And I'm trying to help you understand that as a professional trader, days like today are the days to take the day off. Days like today are the days to say, sure, it's a giant, huge range, but if I don't know what's happening, I have no edge. If I have no edge, I take no trades. Because the downside to large ranges and volatile days is you can lose a lot of money too. And it's much easier to lose because the tempo and the size of the moves is so fast and so big that it has a stronger emotional effect on you, causing you to go into fight or flight mode. When you go into fight or flight mode, when you go into that fear and that panic mode, okay, so we got the ticks back to the zero line. That increases the odds we're going to pass through the opening price. If we pass through the opening price, that would increase the odds that we're going to have either a sideways day today or a move higher from here. Okay, so now that we're at the zero line, we're looking to see, can price get through the open, which is more likely now that we're at the zero line. And then if it gets through the zero line, we're saying, do those ticks keep going higher? If they do, that will be the beginning of momentum up. Okay, but we don't know right now. We could still be going sideways. We could still be going lower. The question is, can they keep this momentum going through the opening price? Through 52.94. So yeah, that's what happens with these large ranges, these large volatile days, is that the emotions are stronger and it throws you into fight or flight much more easily. And when you're in fight or flight, your brain literally creates chemicals to shut down your critical thinking. You literally get dumber. And all you want to do is fight or flight. In terms of trading, that is either forcing your way into trades that you should not be in, which we call FOMO, or exiting trades at stupid locations for stupid reasons. So either getting stopped out too quickly and not giving a trade enough breathing room, or letting a trade go against you and against you and against you, and you just keep losing and losing and losing and losing before you finally are forced to exit the trade. Those are more likely to happen on a day like today. So a professional trader knows a day like today is not a day to step on the gas. A day like today is a day to be extremely cautious. So I agree, DNK, with what you say. SC in the house, good morning to you. Jay, good morning, Pirates. Charles, I say wow. What a great day of trading in the paradise at the big casino. Shook 230 is here. Shook 230, good to see you. Frito in the house. Marketing guy, good to see you. Welcome, welcome. Sook is here. Percy R. Willie T. Danny G. Kevin, no last name. Good morning, Kevin. Frito in the house. Welcome, welcome. Pedro is here. Mr. Reed, good morning to you. Good to see you. Trevor in the house. Tommy is here. Good morning to Johnny. He says, I thought that we keep all references that were gapped over, or is that not the case? That is not the case. So the gap, once the market opens, the gap becomes the repair of all those things. So let's say you got a bunch of weak references up here. Weak, all these weak references, right? If the overnight pushes down through them and then it comes back up and the regular trading hours opens above them, then we keep all those references because they have not been passed through during the regular trading hours. They've just been passed through in the overnight. But if we open down here, then at that moment, the opening bell rings, it is as if we've passed through them. So they all disappear. Now, as I said, today is kind of a unique thing. Normally, I would even get rid of old highs and lows. This would be completely clear. But because I'm expecting a sideways day, or a slow melt to the upside type of day, I need to know where the resistance might be. Previous daily lows from, September or whenever, or August, that's potential resistance levels intraday today. So that's why I'm keeping them on the chart. Okay, so I'm going to put in a new support line here. One at 52.58 and one where the price is literally right now, 52.70. These supports need to hold and the market needs to push its way through the opening price if the buyers are going to stop a sell-off today. We got back to the zero line. And we got price back to the opening price, but we were not able to hold the ticks above zero, and we were not able to cross through the open. That's very important information as intraday traders, because that tells us these buyers that bought the first dip, they're not strong hands. If they were strong hands, we should have been able to get through the opening price. So that means these are shorter term traders, meaning more likely to get squeezed. So if the buyers want to stop us from heading to the overnight low, they must defend 52.70 or 52.54 for support. So here we are again, ticks back at the zero line, price back at the opening price. Can we cross through the opening price? Can those ticks stay above the zero? That's what the buyers need if they want to start this momentum to the upside. Kevin says, during the regular trading hours, you pay attention to single prints. Do you pay attention to them from the overnight session? So it's kind of a yes and no. what I am looking at for the overnight session is the shape of the profile, right? Which tells me what happened in the overnight. It tells me where business took place and what kind of business. So if I'm looking at last night's profile, which is this blue one over here, the lighter blue, if I'm looking at last night's profile and I see that there's a lot of volume up here, and there's a lot of time that we spent up here, and then there's a lot of volume down here, and there's a lot of time that we spent down here, but in the middle, there's a section where there's only one set of prints, a single set of prints, and there's very thin volume inside that section. I don't treat it exactly the same as I would treat a regular trading hours set of single prints, which I talk about in the workshop, how I handle those. But I would just say to myself, if the market can get back up into this area where there was such thin volume and so little time, it shouldn't be that hard for the market to get back up to here. Okay. So that's the idea, is like we either get stuck in this lower end down here, or we work our way into this upper end up here. And that's sort of the question. Again, first, we got to pass through the opening price and hold the ticks. But that's the question I'd be asking myself. Looking at that overnight range tells me where to look for those changes in business. So if the market were to push up and it were to be getting up into those single prints and then it were to get smacked down, guess what the market is telling me? We're going sideways today. We're not going up. Whereas if we got up into those single prints and we just kept going, well, then I know we're heading up into the upper end of the range. Now I can look to buy dips and sell rips. So the idea is not specifically because it's single prints, but it helps me understand the shape of the profile. It helps me understand where business is taking place. And that tells me what to expect when we get there in the regular trading hours based on what happened in the overnight. Okay, so these buyers are working really, really hard. This reminds me a lot of yesterday. This is exactly what yesterday morning looked like. Gap down, immediate selling pressure, and the buyers just kept buying and buying and buying and buying, but they got nothing for it. And so eventually they got squeezed. And that's what this is feeling like to me. These buyers keep trying and trying and trying to defend, but they can't get back through the opening price. So if you're trying to understand what I mean, I'm basically saying in between this support level and the opening price, I'm neutral. I don't know what the market is going to do. But if this support fails, I would be bearish. I would think the market is heading to the overnight low. And if we can get enough support to pass through the opening price, I could become bullish up there for continuation higher. Okay? But in between these two, right now, the market is playing tug of war. And the sellers are having a much easier time of this tug of war. The buyers are working really, really hard right now to try to reverse the momentum. Let's see if they can do it. Eddie says, what is the two-way auction process? Eddie, you got to take the workshop, man. No, I'll give it to you. So basically, we can get way more complex with this, but let's not. Let's keep it extremely simple in the beginning just to understand it. Okay, so that's the pass through the opening price. That is bullish to see. Screens are turning green. So now we're watching those ticks to see, can they keep them above the zero line? If they do, we're likely going to start pressing upward. If the ticks come smashing back down again for the third time, that means the support probably won't hold on the next attempt. It'll probably break. So yeah, to keep things very simple, take the ES contract. For the ES to go up from, 52.96 to 52.97, for the ES to go up a point, there has to be more people going long at 52.96 than going short. If more people go short, it will go down a point to 52.95. And if more people are going long, it will go up a point to 97, right? That's how it works. It is simply a question of, at this exact second, at this exact moment, at this exact price, are there more buyers or are there more sellers in the market? Okay? That's what makes the market do its next move. So how do we make sense of this? We think about it like an auction. An auction is an example that illustrates how this works. Okay? So imagine you got an auctioneer and he brings out a painting, and it's a painting of a beautiful woman, and she's got a big smile on her face. And he talks about the painting, and he talks about the artist and why the artist is so prolific. He talks about other art that this artist has sold and how much it increased in value. He talks about this particular painting, what makes it special. What he is doing is he is trying to convince the people in the room that they want to own this piece of art. But everyone in the room who wants to own this piece of art wants to own it for different reasons. Some people are obsessed with this artist and they want to have all the art they can. Some people just think it's a pretty painting and they want to put it up on the wall. Some people don't give a fuck at all about the painting or the artist. They just want it as an investment. They just think it'll be worth more money. So all of these people are going to have a different price in their mind of what they're willing to pay. One person might say, I'd be willing to pay $1,000 for this. Another person might say, I'd be willing to pay $1,500 for this. Another person might say, I'd be willing to pay $2,000 for this. Okay? So the auctioneer is sitting here and he's talking and he's telling you all about this painting and he's creating this desire for people to want to own it, and they are all coming up with their own price for what it's worth. So how does the auctioneer get the best possible price he can get? That's what an auction is. So he starts off with $1,000. He says, this painting's for $1,000, $1,000. Anyone willing to pay $1,000, $1,000 for this painting? No one raises their hand. Why not? Why does nobody raise their hand? There's people willing to pay $2,000 right now. Well, because everybody wants to get something for as cheap as possible. Everybody wants to get something for sale. So if the auctioneer starts the bidding at $1,000, even if somebody's willing to pay $2,000, they'd rather see if it's going to go lower first. So he lowers the bid. I don't have 1,000. Do I have 900? 900. I don't hear 900. Do I hear 800? 800. Boom, a hand goes up in the air, right? One person is willing, and this is volume. One person in terms of volume is willing to buy at 800. So now everyone who is willing to pay 1,000 or 1,500 or 2,000, they all have to start bidding because again, they all want to get it for as cheap as possible and they know they can't get it for less than 800. So what does the auctioneer do? He raises the price. He says, all right, I have 800. Do I have 900? 900, 900. And then all of a sudden a lot of volume comes in. Now 5 hands, 10 hands, 15 hands go up in the air for 900 because they were all willing to pay a higher price and they're trying to get it as cheap as they can. So you start with very thin volume. You start with just one person willing to bid. But then once that auction reverses, more and more people start to bid. The volume gets bigger and bigger. Look at the low from the overnight. Look at how much volume is near the lows. And then as it turns around and starts going up, you get more and more volume. Look at today's low that we literally just made. Only 200 people willing to buy the low. But once it turned around and came back up, you got 3,000 people willing to buy it. That's volume, okay? So then the auctioneer, he keeps lifting that price as long as people are willing to bid it, right? So he says, I got 1,000. Do I have 1,100? I have 11. Do I have 12? Do I have 12? Do I have 13? And he starts pushing that price higher and higher and higher. Well, as he's pushing that price higher and higher, the volume is going down. There's fewer and fewer people putting their hands up in the air as the price goes higher. Look at the highs from today. What happens to the volume? It tapers off. Less and less volume the higher we go, which means less and less people are willing to go long as they get up there because this person was only willing to pay $1,500 and now it's up at $1,600. So he's not bidding anymore. It's too expensive for him. Well, that's what happened to the buyers this morning above the opening price. It was too expensive. So we put it on sale. We lowered that bid and we found buyers. Okay. That's what the auction process is. Now with an art auction, there's only one painting. So the auction only goes one direction. It just goes up, right? Until you find the person willing to pay the most for that painting. But in the stock market, there's an unlimited number of shares of a stock, right? Or an unlimited number of futures contracts. So the bidding just continues. It pushes up as far as it can push up, and then it turns around and pushes down as far as it can go down. And then it turns around and goes up as far as it can go up, and it turns around and goes down as far as it can go down. Okay? That's the auction process. So if I'm trying to make money as a trader, what am I looking for? Well, first I want to know what price levels matter, right? Where do people start to change their mind? Where does it start to become too expensive? Well, look where the volume and the time tapered off in the overnight. As the market tried to recover, buyers were saying, this is too expensive. We're not willing to pay this, and it kept coming back down. Well, then what happened in the regular trading hours? Same thing. And this is what you will notice over and over again. Areas where the auction tapered off in the past, it will likely taper off in the future, right? So now you have potential support and resistance levels. And more important than support and resistance, you have potential changes in the market where suddenly if you break above that level, you start to squeeze one side of the market. So let's say, in the second half of the overnight, the market was running out of steam and reversing here, reversing here, reversing here, reversing here. In the regular trading hours, we reversed here. Now let's say the market can hold the bid, it pushes back up through the open, and it gets through those levels, and it starts going higher. Well, what happens up here? Two things. One, all these sellers that have been selling, they start to change their mind. They start to say, I don't want to be short. I'm losing money. So they exit those shorts. That's what we call short covering. But also there's FOMO buyers. There's people who didn't buy the support at the time that it was acting as support. They waited for it to break higher, and now they're chasing price. That's what we call FOMO buyers. Speaking of which, I am now bearish. I think we're heading to the overnight low because we could not keep the ticks above the zero line. We could not stay above the opening price. So this is officially bearish. As long as we stay below the opening price from here on out, I'm assuming continuation to the downside. But again, for the sake of our example, let's say the market were to find support and come up here. Suddenly you squeeze all these sellers and you start to bring in FOMO buyers. That causes a big move to the upside. So this is the area where something could change in the market, where things could flip. This is what I'm obsessed with. This is what I spend every day of my life analyzing and thinking about and obsessing over. Where will things change? Where will we force sellers to become buyers or force buyers to become sellers, stopping them out, and cause new people to want to buy or sell, chasing price? Because if I can get in right at the beginning of that, so I sit here and I watch the market, and it dances around, it dances around, it dances around, it dances around. It gets up there, it breaks. I start seeing that new buying. I start seeing that we're taking out those stops. I start seeing those, and I get long somewhere in there. I can make money because it will keep going higher. So a majority of the time, it will be a profitable trade if I can have the patience to wait for it to break, the patience to wait for the confirmation that we have that new buying. Then it's an excellent opportunity. And to be able to do that, I have to see those levels ahead of time and have the patience to wait until I get to those levels to do business. And that is what makes trading hard. I teach all of this in my Mastery of Markets and Minds workshop so that you can see these things for yourself, so you can think these thoughts for yourself, so you're the one that has the edge when you sit down in front of the chart and you start trading in the morning. I'm telling you guys, it's never going to be cheaper than it is right now if you use the promo code Easter. Marketsandmind.com. Okay, so now let's talk about the next location where things could change. We just talked about a location where things could change. What's the next location where things could change? So I've now spent enough time going sideways in here that I have decided the buyers are going to lose. They keep buying the dip and buying the dip and buying the dip and buying the dip, and they're getting nothing for it. They are not getting back through that opening price. They're not getting that follow through that they're looking for. So that means each time it dips, there's going to be fewer and fewer people willing to buy that dip. What does that mean? Eventually, we're going to poke through. Now, I can't time it. I can't say it's going to happen right now or it's going to happen 30 minutes from now, right? I can't time when it will break through, but I now believe there is a higher probability it is going to break lower. So what's the next level I can watch to see what comes next? The overnight low. The overnight low is the next area where things could change. What could change at the overnight low? Well, people who are shorting right now, right? These buyers keep buying, but they can't get up. What does that mean? Sellers. Sellers keep smacking the market down and smacking the market down and smacking the market down. So the overnight low is a place where those sellers become buyers, right? They need to take profits somewhere. So they're probably going to start taking profits at the overnight low. There is a chance that happening, sellers becoming buyers might be enough to start to reverse the market and bring it back up into that overnight range. Well, what happens if the market starts to come back up into that overnight range? Well, then you start getting FOMO buying. That brings us right back up. That is what we call a look below and fail of the overnight low. The sellers looked down there. They tried to see if there was anybody willing to go short down there, but no one raised their hand. No one was willing to do business down there. So price turns around and it comes right back up. To me, this is more likely to happen now than new selling and continuation lower. As I've said, on a daily time frame, I believe the market needs a balance today. I do not believe we need another trend down day for the market. And so if we're going down in the first hour of the day, what does that probably mean? It probably means that's the initial move lower that's going to come back and come back up later on in the day. So as long as we stay below 52.92, the opening price, my assumption is we are heading to the overnight low, 52.10. Okay? Once we get there, I will watch what happens to decide what comes next. If we get there and we get new selling, baby, I will be bearish. I will not fight the momentum. But if we get a look below and fail, it becomes an excellent opportunity to be long for the move back up through the opening price. So I can be short to get there. Then I want to take profits and decide, do I want to get short again for the next move lower, or do I want to get long for the move back up? This is the auction process. This is what trading the auction process is. It's asking the question, who is doing business, where, and is it working for them or not? Are they having success or not? And what they're trying to do. Tommy B in the house, good morning to you. He says, is your tick chart in Sierra? You should be able to get to the tick chart in Sierra by just using the ticker symbol TICK. But mine is not. Mine is in Thinkorswim. Alyssa says, good morning, watching here. I know not only are you watching, but you smashed that thumbs up button. I can just tell because you're good like that. But did the rest of you smash the like button? Come on, guys. I'm giving it to you. I'm giving it to you for free. Do me the small favor of pushing one little button as a thank you. Smash that like. Jay says, professional gamblers need some love, Charles. Not here. They've come to the wrong place. Gin and tonic, good morning to you. Grizzly Bull in the house. 200 Dogs is here. Schrodin. He says, how do you keep the levels accurate through rollovers? Here it comes, dude. You're going to hate this. You're going to hate it, but it is what I actually do. I don't change a thing. I start marking new levels on the first day of the rollover on the Monday of that week. And I use all the old levels exactly the same, and I never change a thing. And it blows people's minds, and they don't like it because it doesn't make logical sense. But it doesn't need to make logical sense. It works. Oh boy in the house, good morning to you. Marketing Guy says, based on all the other courses I've paid good money for, yours sounds like a ridiculous bargain. It is. And that is the number one comment I get from people after they take it. Is they're like, man, I did not expect to get that much information from this course. You are not charging enough money. But those that have been around for a while know my reason for doing this, for creating Pirate Traders, is that I spent tens of thousands of dollars on trading education that was worthless, that didn't really help me. And all I want to do, the way I want to give back to the community, so to speak, is to try to save people from doing that. Save you from having to spend years jumping from this to that, to that, to that, to that, and searching for a system that works. And instead, I want to teach you how to develop your own system that guarantees to work because it's built for you and your psychology and how you approach markets. And I could charge a lot more, but then the people that really need me, the new traders, would never learn. And so what's the point of that? So it looks like I need to add some more cumulative data here. People always ask me, how much do you include in your cumulative data? I just go as far back as I have to be able to see where support resistance is. So right now, going back 300 days isn't enough. Good God, man. So let's try 420 days. See if we can't see some more liquidity. Give that a few minutes to load. There it is. There it is. Real quick, I just want to mention this iceberg that we have sitting up here around 52, looks about 68 is where that iceberg is. So icebergs are a form of liquidity for the market. It's basically a way for the market to advertise, hey, you should come here and do business up here around 67 because there's sellers that are going to go short if you come up here. And all the market cares about is getting as many contracts to change hands as possible. So it'll go to wherever the liquidity is, okay? Now, I would never go long purely because there's an iceberg above or go short purely because there's an iceberg below. That's silly, and it'll mess you up if you do it like that. But if you use it as a single data point in a larger narrative, it can be very valuable. So we just talked about the look below and fail of the overnight low, which is what I believe is going to happen this morning. I think we're going to poke down here below this overnight low. We're going to turn around and we're going to come back up to the opening price. This is one data point I can take into account. Now, I don't know if it'll still be there by the time we get to that overnight low. We may come back up and fill it first before we get to the overnight low. It may just disappear. They could turn it off at any moment. So it might just be gone when we get to the overnight low. But if we get below that overnight low and I start to see support and the volume tapers off and the time tapers off, and then I click over here and I see that this iceberg is still here, that will give me more confidence to go long near those lows to target that move back up. Okay? So I'm just mentioning it now. It's not helping us at all right this minute, but it might come into play when we get to the overnight low. Let's see what happens. Thank you, Alyssa. Appreciate you. Marco says, good morning. I've enjoyed your mentoring for years. Well, I appreciate it, Marco. Happy to have you. Guillermo is here. Good to see you. Nap says 83 points already, the new norm. Just highly volatile. You know, we know this. We've well established there are times where the market is volatile and the ranges are large, and there are times where the market is not and the ranges are smaller. And we are definitely in a volatile time. No one's questioning that. A marketing guy says the initial balance down at 52.25. So the initial balance is the entire range that the market does in the first hour. So currently, that is the initial balance low, but the first hour isn't over. We still got another 9 minutes. So in 10 minutes, we will know what the initial balance high and low is. Michael says, thinking they may breach 5,200 for the move up. Yes. I mean, I again, when you have this volatile of ranges, it's hard to say exactly to a tick where they're going to reverse, but we know where the overnight low is, which is 52.09. So they are likely to go below that level. And then once they get below it, if they don't get new selling there, they are likely to turn around and come back up. So I don't know if it'll go from, 52.09 and then reverse at 52.01, or it'll go down to 51.98, or it'll go down to 51.89. I don't know exactly where, but that's the idea. This is your overnight low. Now that the market couldn't get through the open originally, it's likely to test it. Once it tests it, you find out what comes next. We got an hour till Powell speaks. Doobie doobie doo. Tommy says, thank you, Pirates. Enjoy the trading day. I'm up 470, so I'm happy. If I remember correctly, that puts you at over 1,000 for the last 2 days. It's a living, brother. It's a living. Congratulations. Hem says, look at the NQ sell-off, or the NG sell-off of natural gas. I don't even have that on my scanner. Oh, that ain't no thing, Jelly Bean. It's just inside yesterday's range. If one feels like, oh my God, it's so crazy how far the market is going. Oh, that's because I'm on the weekly. That's what it is. All right, hold on. Maybe it is selling off. Hold on. Okay, yeah, still barely below yesterday's range. Still not a panic thing. But yeah, it is selling off. It is breaking out of this little balance area right here. So you would look for, does this become resistance? Looks like it's a little shy of $4. Becomes resistance, then you would look for it to move down to this low right here. Looks like the gas has been going nowhere for the last couple of weeks. We got 117 people hanging out. We're just kind of chilling, waiting to see if we can poke below this overnight low. Any questions for the pirate? Let me know in the chat. Also, how come only half of you have hit the like button? You've got to be liking this. I've been witty. I've been charming. I've kept my singing to a minimum. R3K Law says, I wonder what kind of gap Monday we'll have. Well, we could play the game. Obviously, we have no clue right now, right? There's so much left to happen intraday today, which will affect what will happen over the weekend. So it's obviously way too early. But if we just wanted to play around with the concept, the idea would simply be this. Okay. So the idea is today is going to be one of three types of days. Either we continue the momentum lower, which would be new selling below the overnight low, which again, I think is the least likely scenario, but still possible. That would be day number one. If that happens, I would feel very confident we will gap up on Monday, because a market can't go straight down forever. It has to balance off excess. So if we were, and again, it's the least likely thing in my mind, but if we were to have another massive down day, trend day to the downside, we would need to cool it off, and that would happen over the weekend. So I would say gap up if we have a trend day down today, but I don't think that's going to happen. What's more likely is that we're just going to have a balancing day at the lower end of the range, the overnight range. Okay, well, we'll go sideways all day today. If that happens, it's impossible to predict what's going to happen next week. Now, on Monday, right, if the market opens above that balance area or below, we'll tell you what to expect on Monday. So if you have a gap down, you can expect more momentum down on Monday. Or if you have a gap up, you can expect more momentum up on Monday. But you couldn't guess today on Friday which way it's going to break. And if you got a V shape today, if the market got below the overnight low, reversed, and just headed straight up towards yesterday's low, then you would be likely to get no gap the next day. You'd be very likely to open inside today's range. So again, we got to see what happens today to know what's going to happen over the weekend. We can only take it one step at a time. Hem chat says smash the like button. Push the button. Frida says, but did you make us breakfast? I made you breakfast with mind food. Eat up. Jay says, scrambled market sandwich, Frito, with a side of chopped broccoli. Thank you, Yokozuna. Appreciate you. Dennis P says, what is the behavior in a bear market? So in a bear market, the way the market behaves differently than it does in a bull market is the elevator down versus stairs up conversation. So if you're not familiar, it's pretty well known, sort of saying in the business that the market will take the stairs up, but it'll take the elevator down. And that's sort of the difference between a bull market and a bear market. The bull market will make moves up and retrace a chunk of that move. And then buyers will step in, they'll buy that dip, and it'll make the next move up. And that'll just keep going as long as it's a bull market, right? But when you get in a bear market, you get very large drops. So what will happen is the price will drop and then it'll just go sideways and drop and just go sideways and drop and just go sideways, rather than in a bull market where it drops, dips, goes higher, dips, goes higher, dip, like that. You know what I mean? So it's the elevator versus the stairs. And we can see that just looking at the last few days. I mean, yesterday was a gap down, drop, went sideways for the day, started the next drop at the end of the day with the spike down, and then the overnight did what? The next drop. And then we opened this morning, and what are we doing so far? Going sideways. So that's just the way the behavior changes in a bear market versus a bull. Okay, we did it. Yay! Boo, 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 boo. We got to the overnight low. This is our target to the downside. This is where we take profits on the short. Not because the market might not keep going lower. It might. It might keep going lower all day for all we know. But because the probabilities shift here. This is an area where sellers start to take profits, and that potentially changes the auction. That potentially flips it the other way. So this is where we as sellers who've been bearish so far this morning think, let's lock in some profits and let's watch what the market does here to figure out what to do next. Because if we get the look below and fail that I'm thinking we're going to get, we actually want to be long, or at least not short. And if we get new selling, we want to be short for the next move to the downside. So let's be flat, because when we're flat, we think clearly. When we're in a position, the position affects our ability to see things clearly. It's called cognitive dissonance. Okay? And it's a very real thing. If you think that you are not susceptible to confirmation bias, you are. Being in a short will convince you the market is going to keep going down. Being in a long will convince you the market is going to stop going down, even if the market generated information isn't telling you that. So if you want to have clarity in reading the market generated information, when you get to one of these levels, you lock in profits, you get that clarity of thought, then you look for the next opportunity. All of this and more in my Mastery of Markets and Minds workshop. marketsandmind.com. It's written right there. You can use promo code Easter. '18 series says the VIX is above 40. It was not that high earlier. Going up. Ding. So having that conversation about the elevator versus the stairs, just look at this. Starts going up, comes back down. Starts going up, comes back down. Up, down, up, down. Here's where the market rolls over. Now look at what it's doing. Straight down, sideways, straight down. It's these big, abrupt drops. You know, in 2 weeks, we go the distance it took 4 months to go up. That's elevator down. That's what we're talking about. And it's just a psychological thing. What you have to understand is the psychology of the participants in the market. When the market is going up, okay, the further it goes, the more money that people are making, right? So if you got long here and the market starts going up, you're making money, you're making money, you're making money, you're making money. It turns around and starts to dip, you're still up. You know, you've still made a lot of money. Whereas when it starts to come back down, let's say you bought right here, and now all of a sudden, again, this is like a year later, so this probably wouldn't be a thing, but just as an explanation, if you were long from here, what's happening now? Each tick that the market goes lower, you are more and more money. So you're losing more and more money. So you're just saying, get me the fuck out. So people get long, and then as soon as it rolls over, everyone wants out at the same time. And so it drops very fast. Because each tick that it goes lower, all those people that went long, whether they went long here or here or here or here, they're all losing money as it goes down. And no one wants to lose money. So they all exit at the same time. We call that getting squeezed. Okay, so earlier we talked about the iceberg. There are 2 icebergs above price now. So I am watching this overnight low like a hawk. Do we get new selling here? Does this become resistance or not? If it does not become resistance, we are very likely to backfill the single prints to 52.44. If that becomes resistance, then we turn around and start heading lower. If not, we're likely to come back up towards the opening price as they look below and fail of the overnight low. Now, we can't make the call right this minute. It doesn't work like that, where you can instantly say, okay, it's going to fail. We're going back to the opening price. We got to give it a little bit of time. But this is where we start watching for that information to decide what is going to happen. Is this market continuing lower this morning, or is it reversing back up through the open? Now is the time to watch. Now is where the information becomes valuable. Watching them ticks. Zach L says, if we see new selling under the PVD, I think what you mean is the overnight low where we're at right now. If we see new selling below the overnight low, where would your stop be? So the idea is if you get short and you take profits at the overnight low, and then you're seeing resistance, you're seeing new selling there, and you're looking to get short, where do you put your stop? And there's two ways to think about it. The first is you can go short and just use as tight a stop as possible and literally say, like, where was the resistance? So if it was, let's just say it was perfectly working exactly as the overnight low, then you'd put your stop just like a few points above there. Now, that trade would be less likely to work out. There'd be a higher probability that the market's going to poke up and stop you out and still go lower, but it's the minimum amount of risk. The way I would personally trade it, if I was seeing resistance at the overnight low, is I would use the single prints from the B period, and my stop would be about a point above the single prints. Because I'd be saying to myself, the market could come back and fill those single prints and still get enough momentum to continue lower. So I don't want to get stopped out inside of there, right? Because I would lose the trade. So I'd have to take a little bit more risk, and I'd have to use those single prints as the stop. Now, if that's too big a stop for you, if you don't take 30 fucking point stops, you know what I mean? Then maybe you can't get in the trade, or you have to trade with like one MES contract. You know, you just have to trade with such small size that you can take the stop. But if you're talking purely about probabilities of success, you know, once you enter that short, you really just need the market to stay below the base of these singles for the short to work. So yeah, again, another thing that is tricky about large volatile ranges is you just have to take on a lot of risk to get in the trade. Zach says, Charles, can I ask you to spell out the odds of an event? What are the odds of a trending up now that it has come through the overnight low? Ooh, that's a great question. So I can give you a framework. Obviously, I can't give you exact odds. I mean, I'm not a computer. I mean, that's too much to calculate, but there are different ways to think about it. So the idea of the look below and fail of the overnight low, right? That is, the market gets below the overnight low, runs out of steam, and then reverses back up. Those odds are the same no matter what. And you just have to wait and see what happens when you get to that overnight low. Now, I would say today, because of what we talked about, because of how far the market already went in the overnight, we have higher odds of a look below and fail today. So just based on that alone, just based on the fact that we're at the overnight low and we already made this huge move of excess in the overnight, I would give it like 70% odds of a look below and fail. Okay. I would say significantly higher than 50-50 that it's going to look below and fail. But what changes those odds? If it had come down in the B period, gotten below there, and then reversed back up before printing the C, I would say, 70 to 80%, we're going to get that look below and fail, and we're going to go lower. Now that we did it in the C period, that's new information. That's different than doing it in the initial balance, because the very fact that we kept selling beyond the first hour is a sign intraday we have momentum down. That momentum down slightly decreases the odds that we're going to get the look below and fail. So because we did it in the C period instead of the B, I would say the odds are more like 65% than 70 to 80%, because we're trending down, and that changes the odds. Now, if you're asking the question, how likely are we to turn around and start trending up from here? Like keep going for hours and hours and hours? I would say those are very slim. If that was going to happen, it should have happened quickly. So the market should have opened, and probably in the A period or the very beginning of the B period, they should have reversed and got back up above the open. So, okay, we are getting some new selling here. At the market open, what did I say were the three scenarios for the day? Scenario one, Market goes sideways and balances at lower prices. Scenario number 2, it reverses with price. Scenario number 3, it goes lower. Now, because we could not get through that opening price, because the C period is trending down, I would say the odds of this one happening are less and less and less every minute. Every minute we spend below the overnight low, the odds of a move higher today are less and less. Every contract that trades below the overnight low, the odds of a move higher today are less and less. The more volume, the more time, the worse those odds are. So at this point today, I would say we're going to get the one of two scenarios. We're either going lower or we're going to just go sideways. And my vote at this moment right now is still sideways inside yesterday's range. But I might be fixing to change here with this new selling. Yeah. No reason to be short here, guys. This is a liquidation. Liquidations retrace. So no need to FOMO into a short right now. Wait for it to come back to the overnight low. Wait for resistance there. If that resistance holds, we will continue lower for hours. If not, we're going to force all these shorts to cover. Okay, this is still a liquidation. Selling is not quite over. We have not reached that magical level where we run out of sellers just yet. So I think we need one more poke to the downside. And so you say to me, well, Charles, if you were short and you took profits at the overnight low, aren't you regretting it right now? Aren't you saying, man, I wish I would have held a runner? Aren't you saying you shouldn't have taken profits? Absolutely not. Because guess what? This what we're seeing right now is new selling below the previous day or below the overnight low. This is the sign we were looking for to be short below the overnight low. So we lock in profits from the first trade. We don't FOMO and we don't chase. We wait for it to come back up again. When it comes back up into the resistance at the same place we took profits, okay? Now the probability of success of continuation lower is much higher. So it's now smart to be in a short at the overnight low for continuation lower. Whereas it wouldn't have been at the time we got there. And then you say, all right, Charles, I hear you, but what if it doesn't come back? What if we just keep selling and you missed it? Well, then that's fine. I miss moves all the time. This theory that people have about opportunity cost in trading, that like any trade you could be in and you're not is you losing money, is fucking bullshit. All that matters is not losing money. That's all that matters in this game. Winning money doesn't fucking matter. The winnings will take care of themselves. What your job is protecting yourself from losses. And so if every now and then to be cautious, you wait for the market to push back up into resistance to get short, and you don't get a chance, it doesn't come back up. That's preferable because you didn't lose any money, as opposed to chasing a short at the low, then it comes back up and stops you out and you lost money. Okay? So again, I know as this thing falls tick by tick by tick, you're like, God damn, I got to be short. I'm telling you, do not short these lows. This thing's coming back. It just hasn't quite caught the bid yet. We are squeezing people. Fear and panic. All right, so I'm looking for a bounce at 51.46. The idea of a liquidation break, which is where the market drops this far, this fast, is that it is not sellers that are shorting the market, making it go down. It's buyers getting squeezed. So we got below the overnight low. We got some resistance there, and now everyone who was long is like, fuck this, and they're getting out of their trades. That's what's making it like the elevator. It's making it crash so far, so fast intraday right now. But guess who buys liquidation breaks? Strong hands. So a lot of times the liquidation break low becomes the low of the day. So that's why we wait. R3K Law says, I wonder if 1,000 point NQ days are the new norm. So again, people always do this, and it just makes me laugh when people are like, whatever's happening right this minute is going to happen forever. Relax. These things happen. We have volatile times where the market is more volatile and times where it's less volatile, and you just adjust. You just adjust everything. You adjust your thoughts. You adjust your tick increment, right? Right now I'm in 4 ticks. The way I'm looking at my chart instead of 2 ticks doesn't mean it's going to be volatile forever. It just means as long as it is, I'll be in 4 ticks. I'll look at the market as being more volatile. I'll treat it like it's more volatile. And then when it's not, when it calms down and it has a million fucking days where it just grinds around in a tight range, I'll look at it that way. But to bigger picture, discuss this concept, yes, the higher we go on the y-axis, the bigger the ranges become just by nature of markets. Okay. So when you're down here, when you're at a lower price level, market is at 5,000 or 7,000, right? A huge change for them is a very small amount of points. So let's take this. This was 2020. So that's the COVID dip. Let's take the COVID dip. So the COVID dip was a 30% decline. But that 30% was only 2,800 points. Okay? Now let's look at the current decline from all-time highs. The current decline from all-time highs is at about 20%, but it's 4,500 points. Okay? So we've had less of a decline than they had on COVID, but it's way more points that we've gone down because the further you go up the axis, the just more volatility you get. But that's why as we work our way further up the axis, CME has to build smaller and smaller futures contracts. That's why they got to go from minis to micros, and then from micros to mini micros. You know what I mean? And now they're just going to make smaller and smaller and smaller contract sizes because the ranges are going to get bigger and bigger. just naturally as we drift up the y-axis. Okay, so here's our opportunity. What do we know about the market right now? Well, for one thing, we know on a daily basis, there is momentum down. We had a spike down at the end of the day yesterday. We had a gap down today. We know we got below the overnight low and we did get new selling, but that new selling was mostly longs getting liquidated, not necessarily new sellers. And we know we are now looking for resistance at the overnight low. So as the ticks, as price is getting up, we may have just missed it actually. As price was getting up to the overnight low, the ticks were getting over the zero line. And what happened? They got smacked down. That's new selling. That is bearish. So that increases the odds. The momentum is going to continue to the downside here. Now, I do think we're still going to need to poke into this overnight low a few more times, but this is bearish to see. It's new selling below the overnight low. Meaning they're still putting their hands up in the air, right? The auction isn't over. It's just an auction down in this case. Nanos, that's what they're called. Yes, thank you. He says, can't wait to trade mini nanos. Yeah, that's what'll happen inevitably. 2 years from now, they'll launch mini nanos, micro nanos, atomic nanos. Another important nuance here. Remember that iceberg we were talking about? They canceled it. It's gone. Gone, baby, gone. This is an excellent scenario for us to find ourselves in. We are right at the overnight low, looking for resistance for the next move lower, and we're just 2 minutes from printing the D. So if we get short 2 minutes from now, we can make our stop 2 points above the C period high. So we can get in with less risk than our potential reward. And if we're wrong and we come back up and we get cessation, we have plenty of opportunity to make that money back on the way up or down later on in the day as we bounce. Food for thought. Powell to speak at 11:30. Yes, sir. We're ready. Ready, Freddie. And of course, as everyone knows, once Powell starts to talk, none of the TA prior to it matters. There's a lot of bots that will listen to every word he says and they will start to react. And it won't matter what was happening prior to it. It's just how they react to what he says. Okay, so there's the D period. So the market just did us a favor. It made it real easy to know if we're right or wrong. From this point on, if we stay below what we call cessation of the trend, which is 2 points above the C period high, as long as we stay below there, the market is likely to go lower. If we cross through there, if we get cessation of the trend, the market is likely to turn around and head back up towards the opening price. So that allows us to measure our risk and understand the probabilities of our success. Okay, moment of truth. There it is, cessation of the trend. All right, so this was the look below and fail of the overnight low. Now we know the market is rotational. So what did we talk about so far today? What is everything we've set up here? We said as the market works its way lower, there's one of three things that could be happening. Either we're going to get a V-shaped recovery and shoot way up here. We've already established with the new selling we got below the overnight low, that's probably not going to happen, right? What was door number two? Door number two was rotation, and door number three was, trend to the downside. Well, this move that just happened right now, that cessation of the trend, that tells us the market isn't going down. So the selling below the overnight low tells us market isn't going up. The cessation of the trend is telling us market isn't going down, at least for now, right? At least for the next few hours. So what does that mean the market is going to do over the next few hours? It's going to go sideways. So now this is about to become a rotational day where we will just rotate up and down inside this range to see what happens. Now, we should be able to get back up to the opening price, no problem, now that we're rotational. But I'm going to treat the opening price exactly the same as I was treating the overnight low. That's the place to look for a change in the market, because we are either going to do one of two things: look above that opening price and fail and come back down like we just did with the overnight low, or we're going to get up there and we're going to start to bring in more buyers and try to break the market higher. Now, I believe the new buyer scenario is less likely, but still possible. So if you put a gun to my head right now and said, Charles, tell me what's going to happen the rest of the day, I think the market's going to go sideways for a few hours. And my guess is that if it's going to break either direction later on in the day, it'll happen much later. It'll happen after Powell is finished speaking. As far as whether it breaks higher or lower, I don't know, but we'll see where price is. As far as that happening goes, if we get above the A period high, we treat it the same as we treated the overnight low. Do we get new buying? Do we get new selling? Same thing with the C period low. But for now, it looks like they're about to chop it up, waiting for Papa Powell. Any final questions for the pirate before I say goodbye? If you have not yet, please smash that like button. I cannot believe I only have 67 likes. So if you can, please smash that like button. And if you're thinking about learning how to read the market using the auction process, the way I have been so far today, it is a way to make sense of the randomness. I highly suggest you sign up for my course. If you buy it right now today with the promo code Easter, it's only $300. That is the cheapest it will ever be. We're about 6 weeks away from the course happening. That'll give you plenty of time to start to get a feel for things so that when we start the actual course, you're ready on day one to hit the ground running. So I hope you all consider signing up. I will see the members of the brigade Monday morning. Until then, I will wish you a happy weekend and happy trading. Any final questions before I say goodbye? Michael says, I'm seeing that low as the low of the day. I would say now that is a higher probability. 2 reasons. 1, it was a liquidation. We always know when the market liquidates, if we don't get new selling, that could be the low of the day because that's where strong hands step in. And then also the look below and fail of the overnight low, which cessation confirmed. So I agree with you. There's a chance this could be the low of the day. There's also a chance this could be the high of the day. Jay says, head to the Discord. Yes, please. Everyone head to the Discord. David says, do strong hands show up with heavy volume? No, the heavy volume comes after. So again, this is the type of stuff, it gets a little more complicated. So you got to really take the workshop to understand it in depth. But we think about every move the market is going to make in the terms of an adoption curve. Okay. An adoption curve is a bell-shaped curve that basically represents the adoption of a new thing. So like, let's say going from riding horses to cars, right? There's always different groups of people that do things. Okay. There are what are called the innovators. Those are the very first people, right? Then you have what are called the early adopters. That's the first bigger group of people. The innovators are a very small group of people. That's like 3% of the population. It's tiny volume is innovators, but you get a little more volume when you get to the early adopters, and then you get the early majority, right? Then you get the late majority, then you get the laggards. So like, if we're talking about horses, it's like, when the first automobile comes out, those very first people to go buy one, when they were totally shit, when they were running on steam, like before they even invented a gasoline engine, like those first people that were like, this is awesome, this is cool, automobiles are the thing of the future. Those are the innovators, tiny group of people that did that. But then they start to make the cars a little better. They start to be a little more rugged. We start to build more roads to drive cars on. Now, all of a sudden, a larger group of people start to adopt that, right? All of a sudden, everyone else starts to see there's a lot of people driving these automobiles. There's fewer and fewer people driving them or riding horses. A lot of people are riding these. And then all of a sudden you get the early majority. And by this point, by the time the early majority has stepped in, half of all the people are now driving cars instead of riding horses. Then you got the late majority. These are the people who are like, I don't want to drive a car, but I don't really feel like I have a choice anymore. Everyone's got a car. They're getting where they're going much faster. Their cars aren't taking shits, in the middle of the road. So eventually everyone starts to adapt this new technology, right? They start adapting to cars. And then you got the laggards, right? Who are the people who they were like, I will never buy a car. I like my horse. I'm going to ride my horse. But eventually there were just no stables for them to put up their horse anymore. Everything was a parking lot. There was no feed supply to get food for their horse anymore because everything became a gas station. And they literally were forced to, get rid of their horse and buy a car because there was no other option available to them, right? That's the adoption curve. So every move the market makes, there is an adoption curve. Those strong hands that bought the liquidation low, those are the innovators. That is a very small group of people and very thin volume. 300 contracts went long at the low. Okay. That's it. We've got more than that going long at every single level right now up here. So when you say, are the strong hands the large volume? No, the large volume comes after. The innovators step in and they start this move. Now, if they'd have gotten resistance and the market would have continued lower, nobody else would have joined that. They would have just lost. But instead, what happened? The market came back up and got through the resistance at the the halfback. I'm sorry, at the overnight low. So then the early majority started to pile in. The early adopters started to pile in, and they took us higher. Well, guess who's getting in now? Guess who's going to go long right now? The beginning of the early majority, and so on and so forth. So the market will keep going higher as long as more people keep getting in, but then all of a sudden we're going to start to run out of people. The very last people that we're going to go long will have, and the market will start going back. That's when the laggards step in. That's when that very last set step in. They get one more little bounce, and then boom, we come right back down because we've run out of buyers. We've gotten through that full adoption. Anyway, take the course. I teach it all there. I have images to make it much easier to understand. And for the rest of the day, enjoy trading the rotation. Assume the market is going to keep coming back to the fairest price to do business, which is currently at 52.30. And enjoy PAL. Should be interesting. Thanks a lot, everyone. Bye. Markets